Hello, and thanks for coming. Thanks for your interest in our program, and thanks for your time in attending our presentation today. I hope that after today you'll have a clearer understanding of what the Positive Theta program is all about. We're excited about our program, and I hope after this presentation you'll be too. It's a separately managed account program for QEP-only investors. This is the performance of the Positive Theta program. We're in the 6th year of our performance, and over that period we've gone through several structural changes. So I'd like to just quickly talk about that. Back in 2007, we started trying to build a track record. The track record was for the purposes of commercialising a trading method that we've been involved with for over 7 years. The way we went about doing this is we formed the Positive Theta Trust. It was a discretionary trust, and we built the track record within that trust for almost 3 years before we formed NCC. It was our belief that we needed 3 years of performance before we had enough evidence to suggest that we have a commercial product, and in June 2010 we reached that milestone and formed Non-Correlated Capital. At that time we launched Positive Theta Fund, which was a unitised structure in Australia. The structure is very similar to a CPO style structure in the US, and we began offering the program as a unitised trust structure in Australia from that date onwards. That fund exists today and is still only available to Australian wholesale investors. We found limited success in Australia with promoting that fund, and in 2012 we decided to look offshore for more opportunities. In April 2012 we registered with the NFA, and shortly thereafter in June 2012 we started the Positive Theta program, which is the program that we're presenting to you today. It's important to remember, however, that structurally it may have changed, but on the trading level we have kept consistent over the whole 6 years of track record. So a little about who we are. I'm going to hand you over to Troy Burns to talk about his background. Troy?
Thanks, Kevin. Well, I began my professional career in civil engineering, but I've been a private trader for over 12 years. Trading is a passion of mine. It first began a passion when my father allowed me to view his broker statements when I was about 14 to track his portfolio. But my passion really came alight 12 years ago when I entered into the options and future market. And since then I've been obsessed with option modelling and quantitative trading strategies. In 2007, Kevin and I decided to commercialise our trading, and I made a transition into trading full time, and at that time we decided to launch the Positive Theta strategies. I may not have many years of institutional experience, but I've had the flexibility of trading my own ideas over the last 12 years, and the opportunity to be able to utilise my own funds in my trading experiences. I truly believe that creative freedom that I've had in the last 12 years has been key in the edge in our program that you see today. I've studied a Bachelor of Civil Engineering. I hold an Advanced Diploma in Civil Engineering Design, a Diploma in Financial Marketing, and I'm currently completing an Advanced Diploma in Financial Licensing Management. At this point I'd like to pass you back to Kevin to speak about his background.
Okay, thanks Troy. My career started in trading in 1999. I was trading internet stocks through the internet bubble. I had the experience of building a lot of capital quickly and then losing a lot of capital quickly in 2000. This experience was quite monumental in my life, and it probably was the key event which really pushed me into understanding more about what I was doing and really ignited the passion that I've in trading that's followed through to today. So I began with a formal study. I attended the Financial Institute in Australia and achieved a Dux of Victoria and National Subject Prize in the Financial Markets course. Perhaps ironically, that didn't go very far in helping me to understand how to make money in the markets. So I continued my search for trading success by looking at trading educators, and first as a student, but then over time I started to get involved with content creation and training. All through this process, I was trading my own accounts and having the freedom to experiment with many different trading styles, many different markets, and many different financial instruments. I had a lot of failures through this process, but those failures led me to new areas, and eventually I found a style that I could stick with, that suited my personality, and allowed me to transition to being a full-time trader. And this is the style of trading that we do in the Positive Theta program today. Before I continue about our program, I think it's important to talk about our US business administrative partners that are based in Chicago. We're in Australia, and for many investors in America, they might be interested in how we manage the business being so far away. We do this by having key partners in Chicago to help us with the roles that are important within a trading program. Capital Trading Group helps us with execution and account management, global trade execution, there's a risk analysis overlay, account allocations and reconciliation, and customer service, especially new account opening, and perhaps more importantly, a phone number that can be called during US market hours and someone can be reached even when it's night time in Australia. The accounting portion of our business is handled by Michael Coglianese. He's a CPA with over 20 years of experience in managing CTA accounting. He looks after our monthly account reconciliation, builds our composite performance capsules, monthly account performance tracking, and does the invoicing and compliance aspects of our business. You can find out more about these companies by visiting the links you see there below. And with that, I'd like to move on to the strategy itself. The Positive Theta program utilises three synergistic strategies that we like to label allocations. The core allocation is based on 50% of AUM and has a single market focus. The macro allocation is based on 50% of AUM and has a multi-market focus. And the tail allocation presides over 100% of AUM and functions as a tail risk hedge. We'll get into the details of each of these allocations, but it's important to see that these three allocations are combined to form the Positive Theta program. The core allocation. The core allocation is focused at the WTI crude oil futures options contracts. The manager will seek to sell these options through a staged allocation process, building into a short strangle configuration. The process of allocation is attempting to seek a better than model valuation on a resultant short strangle position by utilising the benefits of and mitigating the risks of underlying market movement. We control the size of exposure by three factors. For those technically minded, those factors are percentage of credit generated against net asset value, the gamma exposure, and the margin to equity. For those who aren't interested in those details, the simple fact is that we have a means by which we know we have got to our maximum size. Once we are at our maximum size, we manage the risk in the position by way of a three-tiered systematic process. So why the crude oil futures market? The crude oil futures market we chose for several reasons. Firstly, for liquidity. Secondly, for the fact that it has an even and dynamic volatility skew structure. This, in simple terms, means that there are opportunities on either side of the market for both the put options and for the call options. The market also has an almost gapless price performance history over the past 13 years. There's access to the market in an almost 24-hour period every day. And we have a clear understanding of the volatility and directional characteristics of this market through an exhaustive historical dispersion analysis study that we did several years ago. So what was that study? This slide depicts a portion of the study that we did. On the left-hand side of the screen we have an oil chart, and on the right-hand side we have a table. And the leftmost column shows the largest up moves in the market in the past 13 years, ranked in order of magnitude. And the third column down is the largest down moves in the market in the last 13 years, ranked in order of magnitude. By looking at the market in this way, we could then focus on the largest moves in the market and have a look at what the options market did during these extreme market events. This went a long way towards building an understanding of what this market is capable of. Here are two examples: a large up move in the market and a large down move in the market. These were key points for us to analyse in building our risk management and our understanding of how to trade these markets. So this is a typical position within the core allocation. We have what's called a payoff profile. The vertical line is profit and loss. The horizontal line is the underlying oil price. And the blue line with the diagonals is the payoff outcome at expiry should we sell a put and sell a call. This typical position is called a short strangle. So the blue line shows a very wide profit area from the short put strike through to the short call strike. That profit area is obtained at expiry. Prior to expiry, outcomes are different, and on initiation, the profit and loss outcomes follow the red line. So therefore, this kind of position is most vulnerable in the early stages of the position. What we're going to do is control the risk in the position throughout the life cycle of the position. From this red line on day one, and then as each day passes, the outcome becomes better until finally at expiry, this is the outcome with the wide profit potential, a large price range in which we can achieve profitability. So how do we manage that? We have three risk engines. We try and estimate a volatility range in the market by using a Garch-based volatility estimation method, creating boundaries in the market. And if those boundaries are breached, we have to look at risk mitigation action. We do draw tracking, so we track the draw within the market to make sure that we don't breach certain drawdown levels. If we breach certain drawdown levels, we need to take an adjustment action. And we also use option modelling software to create what-if scenarios to see what might happen to the position over a range of prices. All of these risk systems feed into an adjustment process. Breaches in any of these risk systems will result in an adjustment, and typically the adjustment will be reducing exposure to the threatened side, adjusting delta, and that portion that's come off will then feed back into a reallocation process. So here we are with the same chart again, but this time we're depicting these boundaries that sit in the market. The dotted lines initially are the boundaries on day one of the position, and you can see they're quite tight. But over time, we can loosen those boundaries and the potential for profit increases, or the probability for profit increases over time. If any of these thresholds are breached, we need to adjust the position. This is an example of if the market moves down and breaches a risk management threshold, we reduce exposure to the short put, and the net effect is that changes the payoff profile to allow for further downside movement. And this is an example of an adjustment to the upside in which we reduce exposure to the call, and it changes the payoff profile so that it allows for further movement to the upside. If you look at this series of charts, you can see the benefit of working with these kinds of strategies because our risk management controls become better over time. So day one, a week into the position, 2 weeks into the position, getting closer to expiry. So you can, just to repeat that, you can see how over time the position becomes easier and more probable to achieve profitability. And with that, I'd like to hand you over to Troy to explain the macro allocation.
Thanks, Kevin. The macro allocation is the other half of the account, and it has a diversified focus, and it's opportunistic in nature, where the core allocation is single market focused and it's consistent in nature. On the screen here you can see the multi-market nature of the macro allocation. But before I go into details of the macro allocation, I'd like to run through a study that we did about 3 years ago. The study was to see the effect of an account if you were to sell out of the money options across 26 future markets in the front month for the last 12 years. We used predefined delta levels to select the options sold and sold them in the front month only. If the option strangle sold went into the money during the month, we would close that position out for a loss and maybe a potential profit. If the options didn't go into the money during that time period, they would expire worthless and maximum profit was kept. The next chart illustrates the equity curve of that strategy. The equity profile illustrates the test is very consistent with very low levels of volatility up to 2008. Then the strategy begins to show large drawdowns in the drawdown graph here. The drawdowns are a direct reflection of the volatility seen in the commodity market since 2008. So September 2008, May 2010, August 2011. Basically, the study shows being short option strangles has a very good expectancy, but you don't want to be short when the commodity markets break down or rally uncontrollably. On the next slide, you'll see a snapshot of what we call the allocation matrix. The allocation matrix essentially is the data collected from the short strangle option study that we did. Each row in the matrix represents an individual future contract. There is 26 columns in total, covering 26 future contracts. Each row in the matrix represents a month that the option was sold, starting from January 2000 up to present. The red cells illustrates when the sold strangle went into the money and had to be closed out for a loss and maybe a profit. The clear cells illustrates when the strangle expired worthless and maximum profit was kept. NCC uses the allocation matrix as a framework to assess probability when to buy or sell option strangles in the macro allocation. The macro allocation doesn't trade 26 future markets every month. Instead, it tracks 13 of the most liquid and least correlated markets, and it has a proprietary pattern unique to each contract designed from the allocation matrix to signal when it's the most opportunistic time to buy or sell strangles in any given market and month. On the next slide, you'll see how the allocation proprietary patterns work. The table shows 13 markets that the macro allocation tracks. There are 2 columns for each contract. The right side column represents the allocation matrix for that particular contract. The left side column represents the proprietary patterns for that particular contract. The purple cells illustrates when the option strangle is sold, and the yellow cells illustrates when the option strangle is bought. The risk management of the macro allocation is defined by utilising risk budgeting, predefined stops, and a diversification model. Predefined stops are identified as soon as the option strangle is entered into the market. As soon as an option goes into the money, the option is closed out. The risk budgeting is constructed by dividing the 50% of the account up into 10 silos. When there is a signal in the macro allocation, one of those silos is given to that particular signal. Each silo represents 37 basis points of exposure. The diversification model is defined by 3 types of diversification. diversification in time, position, and markets. Diversification in time is created in the way each option contract expires at different times in the calendar date. For example, currencies expire at the start of the month and precious metals expire at the end of the month. This creates a staggered gamma profile in the portfolio. Diversification in position is created by the allocation matrix and how it allocates differently across the 13 markets. The allocation matrix also has a concentration stop, so no more than 5 contracts can be traded at once. Diversification in markets is created by the inherent market correlation. So that's the diversification model. It's across diversification in time, markets, and position. So that's the macro allocation. At this point, I'd like to pass you back to Kevin to speak about the tail allocation.
Thanks, Troy. Okay, so we've broken out our program into 3 separate strategies for a reason. We believe that each of the 3 strategies can exist by themselves. Specifically, the core allocation and the macro allocation can weather the storms of the market in their own right. We've looked at systemic risk events of the past 13 years and how they apply to each the core and macro allocations, and we're confident that we can manage the risk in those 2 strategies independently, and each strategy stands on its own. However, what happens if there's an event in the market that has never before been seen? This kind of event may take the form of the market closing and not opening again for a week. If we can't get access to the market, we may have problems removing or reducing exposure in the other 2 allocations. So this is the purpose of the tail allocation. The tail allocation is insurance for extreme events. What you see here is another payoff style diagram. The diagram on the right is the payoff profile for a short strangle position. You can see in the extremities, risk is undefined. What we try to do every month is expend 20 basis points of AUM to buy very low delta options outside or further out than the short option exposure on both the put and call side. Typically, the short option exposure, which is depicted at these points of the payoff, is around the 10% delta level, and typically the long exposure is around the 1% delta level. We will buy 2 times the amount of long options than the amount of options we've sold at the 10 delta strike. The effect of this is that it changes the payoff outcome so that an extreme event, in theory, beyond anything we've seen before, can actually be profited from, and at the very least, the risk component associated with an extreme event can be mitigated. So, the tail allocation. 20 basis points of AUM will be utilised to purchase options to backspread the crude oil portfolio. It's executed within the first 3 days of the calendar month, typically 45 days to expiry, and it's initiated within the crude oil futures options market, with an additional long options purchased to cover macro allocation exposure. This chart depicts the interplay between the 3 allocations. What you see here is the crude oil volatility index. This is the VIX of oil. What we see here is a typical cycle of volatility in the market. Initially, the market is in a relatively low volatility state. Then there is a spike of volatility created by some event in the market. Then a period of high volatility, and then a period of gradually declining volatility. This is very common in terms of volatility characteristics across all market types. The core allocation is attempting to generate alpha across the entire volatility landscape. The core allocation will be successful in declining volatility environments and will tend to underperform in these initial spike environments, spiking volatility environments. At that point, the core system risk management will be initiated to protect the downside involved with a shifting volatility state. After a high volatility event, typically the macro allocation becomes more active. Perhaps initially buying a strangle to benefit from the high volatility period, and then switching to short strangle positions to benefit from the declining volatility condition. The core allocation is consistent. The macro allocation is opportunistic. Then we have the tail allocation, which presides over the entire portfolio and functions as tail risk insurance and goes some way to reduce annual volatility. So to return to the original chart, to recap, we have the core allocation. It's always in. It's consistent. It goes every month. It uses half the AUM. It has a single market focus. Then we have the macro allocation. It's opportunistic. It's more lumpy in its distribution through the year. It has a multi-market opportunity focus. And then the tail allocation functioning as risk control and strategy protection. These three allocations work in harmony and combine to form the positive theta program. So now I'd like to hand you over to Troy to talk a little bit about NCC's trading history. Troy?
Thanks, Kevin. The foundations of the trading program have been consistent over the last 6 years, but in that time we've had various revisions. The last major revision was in May 2011, which on this chart you can see the effect of that revision. We've reduced the margin to equity dramatically, but been able to maintain the constant performance trend line. Our daily volatility has reduced dramatically as well, as you can see there. Also, the chart illustrates very significant events that the program has traded through. The program's traded through the flash crash of May 6, 2010. We've had exposure in the crude oil market for over 6 years, and in that time, the OVX, which is the volatility index of crude oil, has jumped above 48 times and hit a massive 100 in 2008, where we traded crude oil from $80 up to $147 and down to $37. The program also traded through the cotton spike of May 2011. During that rally in cotton, the future contracts locked limited 4 days in a row, and if you were short that position, short futures in that position, you would not be able to get out. But the option markets were very active, and we were moving positions in and out of the market as that underlying contract was locked out. The next slide shows our performance. As you can see there, in the early stages we were more aggressive. The targets were more based on volatility and the landscape of volatility. We are now, since the last major revision, we are now targeting 20 to 30% annual returns with volatility of 5 to 10%. At this point, I'd like to say thank you for listening to our presentation and spending the time with us. If you request any information or have any questions, feel free to reach out at info@noncorecap.com. Thank you.